It's been a rough year for crypto.
Got Bitcoin getting hammered today, hitting its lowest level since last July.
$2 trillion free fall rattles crypto to the core.
Winter is here, the tide is completely out.
And in this chaos, there's a massive bet happening under our noses, one that could profit off the total collapse of crypto, shorting Tether, the world's largest stablecoin. Hedge funds are betting hundreds of millions that Tether will lose its peg, crashing completely. And that might have something to do with the fact that just a few months ago, investors watched another stablecoin, UST, do just that. Many investors think Tether is next in a long line of failed stablecoins, but that's not the only reason for shorting Tether. In its 7 years of trading, it's been plagued by controversy, scandal, and even criminal investigations. There have been persistent questions about who owns the company behind the coin and whether the business actually has the assets it claims to own. You know, the assets that are supposed to back the coin. With all that, shorting Tether, meaning betting that it will fall, may seem like a good bet, but hold on. Because Tether is a very different digital currency than the fallen UST, and for better or for worse, Tether plays a critical role in the entire crypto space. In fact, Tether, known by its ticker symbol USDT, is so central to the crypto market that a Tether crash could collapse the entire market. Let's break down what you need to know about stablecoins and the great Tether short. First of all, Tether is a stablecoin. A stablecoin is a digital currency that's pegged to the value of another currency, or a commodity, or some other asset. Stablecoins are extremely useful if you're a crypto trader. You don't have to keep converting to and from fiat currencies, and they're excellent for international transactions, perfect for avoiding money transfer fees and banking delays. Like many others, Tether is pegged to $1. That's also true for UST, or it was true until it wasn't. But not all stablecoins work the same way. Tether is actually very different from UST. Tether is a fiat-backed stablecoin, while Terra is an algorithmic stablecoin. UST wasn't backed by a fiat currency or gold. It was backed in part by a digital token called Luna. The whole idea was to keep UST's pegged to the dollar by balancing it against Luna through arbitrage. 1 UST is always redeemable for $1 in Luna. So if UST's value fell to, say, 98 cents, there is an arbitrage opportunity, an incentive for people to trade their UST in, burning it in the process. This decreases the supply and helps get the price back up to $1. But this was really a faith-based system, and let me tell you, people lose faith quickly. In May 2022, it all hit the fan. Most UST holders began selling, and it became completely unpegged from the US dollar. It went from being worth around $1 to just 2 cents. The Luna mechanism just didn't work, creating one of the darkest events in crypto history, an Enron-sized collapse. This caused investors to bail on stablecoins as a whole, and since then Tether has lost billions in market cap. The reason being, many people just don't trust Tether. They don't believe it can actually be redeemed for $1. If this were found to be true, the entire crypto market would essentially collapse. I can't tell you enough how bad this would be, even if you don't hold USDT. So at this point, it's probably a good time to dig up the facts around Tether and let you decide for yourself what you think about this company and this stablecoin. Tether's business has been unusual from the start. It launched in 2014 by a trio of entrepreneurs, one of whom was the former child actor Brock Pierce, who's actually kind of my neighbor here in Puerto Rico, but that's neither here nor there, because Pierce was in and out of a number of tech startups before Tether, and Tether was no different. He and his partners quickly sold Tether to new owners, and things appeared to go really well. After the sale, the crypto exchange Bitfinex launched Tether token pairs. That's huge for any token. The Tether promise was that each token is 100% backed by US dollars held in reserve. It made perfect sense for crypto. But then things got weird. Remember how Bitfinex was the first crypto exchange to offer Tether? Well, it was no coincidence. In the 2017 Panama Papers leak, it was revealed that the new owners of Tether also own Bitfinex. Shocked by this, investors sued Tether over this deception, and it didn't end there. An avalanche of lawsuits against Tether were building in the shadows, and the same year, Tether got hacked to the tune of $31 million and had to rebuild its platform. For a year while that was going on, customers were unable to withdraw cash from the company, but investors didn't seem to care much. I mean, hey, the value keeps going up. The same year as the Panama Papers and the hack, Tether's value actually soared from $50 million to $1.4 billion. Tether was becoming big business, but big business gets more scrutiny. Questions about their assets become more and more important. In 2019, investors noticed that Tether had removed its claim that all tokens are 100% backed by US dollars. The company now said it's backed by currency holdings and other commercial assets, including loans made to third parties. All of this got the attention of New York State's Attorney General. The AG alleged that Bitfinex had had improperly siphoned off $850 million from Tether to cover up losses in Bitfinex customer accounts. Apparently, Bitfinex had been scammed as well by a shadow banking service and was trying to cover up this embarrassing loss. In 2021, Tether settled with New York State, paying an $18.5 million fine and admitting no wrongdoing. As part of that settlement, Tether agreed to release additional information about its assets, and many had hoped that this would mean regular audit. But so far, Tether's only released attestations, which are not as detailed as full audits. The first one of these showed that less than 3% of Tether's assets were in US dollars, and nearly half of the total at the time was in commercial paper, meaning unsecured loans the company made to third parties. But why does this matter? Simple. Unsecured loans aren't nearly as safe as US dollars. With these loans, Tether had turned itself into a shadow bank, an unregulated lender. And who might borrow from unregulated lenders? People who can't get loans elsewhere, risky borrowers. So the question remains, what are those assets really worth? It's practically impossible to say given Tether's secrecy. And many skeptics have pointed out that Tether's accountants are located in the Cayman Islands, a notorious tax haven. So if you want to short Tether, there's no shortage of good arguments on your side. Now, short selling again is essentially betting that the price of an asset will fall. The further it falls, the more money you make. To short sell USDT, you need a trading platform that allows you to do it. Connect to the Aave platform, and then on Aave, supply DAI and borrow USDT. Of course, none of this is financial advice, but FTX is also really cool because not only can you buy cryptos, but you can also purchase NFTs and now stocks on the same platform. There's really nothing quite like it online. Again, they will be linked down below. So the question is, should you do it? And what are the implications? Again, Tether is a central part of the crypto ecosystem. A crash would be terrible for the entire crypto world. We don't want this to happen. We really don't. Many traders make short sells using Tether rather than against Tether. So if you're betting Bitcoin will fall, you might short sell Bitcoin using Tether. If Tether were to collapse, Bitcoin's value would soar relative to Tether. And as a short seller, you would be cleaned out. That's bad. And that's not all. Many crypto exchanges use Tether in their day-to-day operations. This is often their cash flow. A Tether crash would almost certainly cause many crypto exchanges to collapse. Catastrophic. And what's more alarming is there's big money pushing to make this happen. According to the Wall Street Journal, hedge funds have put hundreds of millions of dollars into bets against Tether, and naturally they want to make sure those bets pay off. Tether execs have accused the hedge funds of trying to start a panic in the markets. They argue something completely different. They say the recent Terra collapse is actually proof that Tether is healthy, that the Terra crash was a test that Tether passed with flying colors. But many investors are still running for cover. During the Terra meltdown, Tether briefly became unpegged from the US dollar, falling as far as 95 cents before eventually recovering back to its dollar peg. In the space of 10 days, Tether had to redeem $10 billion worth of tokens, and the company's boasting that they did so successfully. So if nothing else, Tether's at least more stable than UST ever was, which isn't saying much, but it's something. And especially since Terra's crash, Tether's management seems to be taking investors' worries about its assets more seriously. It announced recently that it will reduce its commercial paper holdings to less than 10% of its entire portfolio in the short run, and in the long run, bring that down to zero. If they actually go through with it, if they're telling the truth, Tether won't be an unregulated bank much longer. This will absolutely make them more stable, which is what they should be. But without full details on their assets, we can never be totally sure, and that's the problem that still lingers. One thing to note here is that short selling a stablecoin is somewhat less risky than shorting other things. If you short sell Bitcoin and it soars, that's bad news for you. If you short Bitcoin at $30,000 and it goes to $100,000, you just lost $70K. But a stablecoin pegged to the dollar is unlikely to ever soar way above $1, so there's less downside risk built right in. This also means you could short Tether as a simple hedge against its risks, which I suspect is what some hedge funds are also doing. But don't forget that in order to short sell something, you have to borrow it, which means paying interest. It's not free to do. You could easily lose money waiting for that Tether crash to come, a crash that may never happen. And I think despite the shadiness, a total Tether crash is unlikely. At the end of the day, shorting Tether is an all or nothing proposition. There's not much upside or downside so long as it stays pegged to the dollar. But with all these hedge funds piling up bets against Tether, you might be thinking, what do they know that I don't? Well, maybe not that much.